Hi, everybody. Interesting news with student loans. There's a lot of things changing. And when Lindsay came on, she said a new rule just dropped. I'm going to introduce our panelists and then let them take it away. So, Lindsay Clark is Savi's chief borrower advocate and a strong champion for student loan borrowers. She joined Savi in 2018 and is the Director of External Affairs. Lindsay has been a regular contributor to our Leaders in Housing Counseling webinars and consistently does a really great job breaking down the complex student loan rules and regulations in a way that's clear and easy to understand. Later on, joining Lindsay will be Dylan Clark, Savi's Customer Success and Operations Manager, and Dylan will stay on after Lindsay's presentation to help address any questions from participants. Oh man, I'm frozen.
We can hear you.
Oh, okay. Well, with that, I'm going to hand it over to Lindsay. Perfect timing. Nice face I have there.
Awesome. Thank you so much, Ellie and Ebony. And it's great to be with you all once again. I can't remember what or the number of times I've joined these quarterly calls, but it's always a pleasure. And I appreciate the opportunity to be able to share some of the sort of policy and program updates. It feels like it is always changing, and that's certainly the case, as Ellie mentioned right before this. The Department of Education dropped its final rules around the implementation of the One Big Beautiful Bill Act that's going to come about July 1. It's about a 650-page PDF that I'm currently digging through, but we'll touch on some of those big changes that are happening on today's presentation. So a quick look at the agenda that I'm going to cover here today. I'm first going to do some brief introductions of myself and who we are here at Savi and our relationship with NHRC. And then we're going to dive into sort of the meat of the presentation. I'm first going to give sort of a refresher, maybe for some, maybe an introduction for others, on two very important federal student loan programs. The first is income-driven repayment, or IDR. This can be a powerful way to help lower your monthly payment. And then public service loan forgiveness, or PSLF. This is essentially full forgiveness on the remainder of your loan balance if you work for a qualifying public service employer, any government entity, or a 501c3 nonprofit. So many of you all in the audience here today. So we're going to touch on those programs just to sort of help anchor when we move into the policy updates. So when I refer to those programs, you have a better understanding of what I'm talking about. And in that section, I'm going to sort of walk you through all of the most important things that are going on right now as of today, April 30th, and any important action that you or those in your communities might need to take or be aware of as we move into the coming months. And then we'll wrap things up by showing you the Savi tool and resources and how to get started with Savi. The whole sort of reason behind Savi's existence is to help borrowers navigate these programs and changes. So we'll touch on that at the very end. And as Ellie and Ebony mentioned, if you have any questions, please put those in the Q&A. We may be pausing periodically to answer some out loud. I'll be joined by my colleague Dylan later on in the presentation. So we've got about 2 hours here, and we hope to try to answer as many, if not all, of the questions that you might have. All right, so my name is Lindsay Clark. I'm the Chief Borrower Advocate and Director of External Affairs here at Savi. And I'm a student loan borrower myself. I have a little over $200,000 in student loan debt between undergrad and grad school. And that balance seems to keep growing, which I'm sure many of you who have student loans are familiar with that feeling. I say this, one, because maybe it makes some of you feel better about your own situations in comparison. Maybe you have a lot less student debt than I do, in which case, mission accomplished right off the bat. But two, because being a borrower impacts how I communicate about these topics. I wasn't always a student loan expert, and I know firsthand how overwhelming and complicated this system can be. And so, my goal here today is not to read and speak to you. It's really to help you understand these programs in a way that maybe you never were able to before, to communicate some of these complicated topics in a way that's easy to understand, but more importantly, makes it clear what action you may need to take and the path forward, right? That's always something I find is elusive for many student loan borrowers. Between all the constant changes, it's very hard to get a grasp of what that finish line looks like and how far away you might be. So that's really the goal of today. Now, I work for a company called Savi. Savi is a social impact technology startup based in Washington, D.C. We were founded by student loan experts and advocates who had been fighting on behalf of the borrower for more than 2 decades. And we realized how difficult it was for borrowers to navigate many of these federal repayment and forgiveness programs on their own. And so we decided to do something about it. So we developed Savi as a technology platform and a human service to help borrowers like many of you and like myself not only better understand our student loans, but to successfully make it to that finish line, right? But along the way, our goal is to make the experience of being a student loan borrower a better one, because I think we can all agree, whether you have student loans or not, it's not a great one. So we try to do that by identifying as much additional savings as possible on a month-to-month basis through things like income-driven repayment plans. But really, we do it by putting borrowers, not their student loan debt, first. Okay. There are a lot of companies and entities that exist out there purely to service or make money off of student loan debt, right? And that's not us here at Savi. We consider ourselves advocates of the borrower, and we put the borrower's needs and their outcomes first, right? Which makes this a little bit different. So we don't replace the federal government agencies and servicers, right, and their role. We help to facilitate those interactions that borrowers might have and reduce that friction to help a borrower achieve the best outcome possible. Which brings us to why we are here today. We have had the immense pleasure of working with NHRC actually since Savi's very beginning. I want to say maybe about 2018. And it's amazing to continue working with Ellie and the rest of the NHRC staff around these issues. They certainly understand that student debt is something that impacts so many of you and your communities. And so we've been sort of excited to be able to continue this partnership and provide our tools and resources as an exclusive student loan benefit to the NHRC community. So not just anyone can access Savi. We work through these partnerships. We have some incredible partnerships across the country. We're trusted by over 10,000 employers and membership organizations nationwide who have access to our tools and resources, not just for themselves, but for their family members as well. And I think that this is really important. I don't know about many of you who have student loans, but I say that it runs in families, right? I have student loan debt. My brother has student loan debt. My dad has student loans for my brother, right? It's very common that if you have student loans, you either know someone else who does or are related to someone who does. And so our goal is to not just provide these tools and resources to you, maybe the member, but to your broader community as well. So again, this is a benefit that is accessible to you and your family members. And I'll show you later on in the presentation how you're actually able to invite those family members to take advantage of Savi as well. All right. So, with introductions out of the way, we are going to dive right in. And again, for some of you, this may be sort of a refresher, a little bit repetitive, but I'm going to try to condense it as much as possible. I just want to give everyone a good foundation before we talk about some of these more recent policy changes. So let's talk about income-driven repayment plans, or IDR. So these can be a powerful way for many borrowers to lower their monthly payment. Now, before I go into sort of the details about what income-driven repayment plans are, let me sort of back up for just a second and give some basic context around how repayment works in general when it comes to your federal student loans. So if you have federal loans, when they go into repayment for the first time, right, you're usually given about a 6-month grace period before that first bill is due. You'll get that bill in the mail, right? And that is reflective, that bill and that payment amount is reflective of you as a borrower being automatically put onto what's called the standard repayment plan. And the standard repayment plan calculates your monthly payment on two things and two things alone: your total student debt balance and a 10-year payoff horizon. Okay, so it's pure math. All right. Now, for many borrowers who have a much higher student loan balance, right, that monthly payment on the standard plan can be upwards of $1,000 or $2,000 a month. And I speak from personal experience here, right? For many folks, it's just not affordable. Over the decades, the Department of Education and presidential administrations understood that the standard plan was simply not going to be a viable way for many folks to pay back their loans. So they started introducing what are called income-driven repayment plans. And instead of basing your monthly payment on how much student debt you have and a finite payoff horizon, they base it on two entirely different things: your income and your family size. So you could have $500,000 in student loan debt. It wouldn't matter. If you're making, let's say, less than $30,000 a year, you could qualify for as low as a $0 monthly payment on an income-driven plan. Okay. So when it comes to these income-driven repayment plans, there are currently three different types of plans that you can enroll in right now. This is on the first bullet you see here. There is PAY, which stands for Pay as You Earn, IBR, which stands for Income-Based Repayment, and ICR, which stands for Income Contingent Repayment. Now, we're not going to go into the weeds on the differences between these plans here today. A lot of it comes down to your disbursement date, your loan type, and things like that. I will say that it's been pretty common for each new presidential administration over the years to sort of introduce their own flavor of income-driven repayment. All right. So that's why we have several instead of just one. Okay. Because they were introduced at different periods of time under different administrations. Which brings me to the SAVE plan. Some of you may be familiar with this. This was introduced under the Biden administration as an income-driven repayment plan. It was the most affordable IDR plan to date. It basically cut payments in half for most borrowers. However, due to ongoing litigation, and now that has just ended and there's been sort of a resolution, the SAVE plan is being terminated. So not only are you not able to enroll, but borrowers are actually going to be forced out of that plan in the coming months. And I'll talk more about that in the policy section. All right. But just wanted to clarify it here. So that leaves currently three income-driven repayment plans, okay, that you can enroll in. If all of the acronyms start to get confusing, the easiest way to think about it is this. Income-driven repayment, or IDR, is sort of the category or descriptor term here, right? And those three plans are the different types of income-driven repayment plans, okay? But they all generally work the same way. They cap your monthly payment at anywhere between 10 to 20% of your discretionary income. What is discretionary income? Well, part of your income is set aside to cover the cost of living, and the leftover amount is called discretionary income, and that's what your payment is based on. So I'll give you an example. Let's say you file your taxes as single, you have no dependents, and an income of around $52,000 a year. On an income-driven repayment plan, that's going to come out to around $160 a month. Now, for every child dependent that you have, that will typically lower your monthly payment by about $50 per child. Even unborn child dependents count, okay? And it could lower your payment as much as all the way down to $0 a month. Okay, so it's sort of a sliding scale, right, based on that income and family size. There's no cap as far as income goes. So you could be making $500,000 a year and still enrolled in an income-driven repayment plan. Obviously, your payment amount would be much higher, right, because it's based on that income. Now, in order to enroll in one of these income-driven repayment plans, you need to submit an application, okay? Because you're automatically put onto the standard plan. So to change out of that, you'll need to submit these documents. This application requires that you attach supporting documentation attesting to your income. This can either come in the form of your most recent tax return or a pay stub from the last 90 days. It gets submitted to your federal servicer, so that's Mohila, Nelnet, Ed Financial, right? Those guys. They review it and they say, okay, Lindsay, you're going to be on the pay plan and you're paying $160 a month. And it locks in that payment amount for 12 months. 12 months comes and goes, and you have what's called a recertification deadline. And in order to maintain yourself in that plan, you basically have to repeat the process of submitting that application and documentation, right? With updated income documentation. And you have to do that every year by that recertification date in order to stay in the program. If you don't and you miss that recertification date, your payment will go right back to that standard plan, which for many folks is going to be a lot higher. Now, you can always apply again, right, and get back into it. But again, in order for that continuity, you want to make sure that you are submitting and resubmitting by that recertification date each year. Okay. But the sort of implication here is from year to year, based on any fluctuations in your income and family size, whether up or down, your payment amount can go up or down. So it is not a fixed set payment amount, right, for a decade or more. Okay, it's changing each year. Now, when it comes to these income-driven repayment plans, borrowers are actually eligible to receive forgiveness after they've made a certain number of payments, usually 20 to 25 years worth of payments. Now, because it forgives the remaining balance, okay, which means the original principal balance and any interest that's accumulated, the whole shebang gets forgiven, all right? Sort of the mentality here, if you're trying to set yourself up for that forgiveness, is to minimize your monthly payment, right, to maximize the forgiveness. The less you pay, the more you get forgiven. There's no sort of brownie points for paying extra than is required each month. In fact, it's almost like you're throwing that money out the window because it would have been forgiven anyway, right? So it's a different sort of perspective than trying to pay down and pay more, right? Similar to maybe what you do on your credit card. This is a little bit different, right? Because again, you're trying to pay as little as possible, knowing that you are setting yourself up to receive that forgiveness at the end. Now, when it comes to income-driven repayment forgiveness, this was tax-free at the federal level through the end of 2025. However, unfortunately, starting in 2026, this forgiveness is considered taxable income. So this is something that borrowers are going to want to consider if that is their sort of plan to pursue. How long you pay for depends on a few factors like the plan and the loan type. So you can see here, depending upon the plan, right, it's a different period of time. For pay, it's 20 years, ICR 25. You know, for IBR, it's going to stipulate whether you took out loans before or after 2014. A lot of complexity here, right? All to say, one of the great things that I'm going to show you at the end of the presentation about the Savi tool is that it's going to be able to identify not only the best income-driven repayment plan for you, but exactly what that timeline looks like based on where you are here today. And we'll outline the next steps on that sort of path to the finish line. When it comes to receiving this forgiveness on an income-driven repayment plan, there's no additional application needed. You know, once you've reached that threshold, it's processed automatically. All right. And I just want to clarify that income-driven repayment forgiveness is different than the forgiveness we're going to talk about here in just a second, which is public service loan forgiveness. That forgiveness is based on your employment qualifying. IDR forgiveness would be something you'd pursue if you didn't work for a qualifying eligible employer. And so this would be the only option or pathway to getting those loans forgiven.
So there's a couple questions I think would be good to kind of throw out there right now.
Sure, yep.
Do they just use your debt obligations to determine your discretionary income, or is there some supplemental paperwork to accurately capture expenses?
Yeah, so they don't look at your expenses at all, really. They're looking at your adjusted gross income from your tax return, or if you submit a pay stub, they're basically, let's say it's a bi-monthly or you get paid every 2 weeks, right? They'll basically use that pre-tax number and extrapolate it out over the year as your income. So this is going to be pre-tax. They're not factoring in those expenses. They're looking really at that line item on your tax return for your adjusted gross income. I will also say that it's going to depend on your tax filing status. If you file your taxes as single, it will look at just your income. If you are married filing jointly, it will look at the joint income. If you are married filing separately, it will look at just your income. Okay. So that can play a big role as far as the sort of reportable income that the payment amount is based on.
And how is cost of living determined for the IDRs?
So cost of living is not does not factor in at all. They are basically looking at that income, your adjusted gross income as supported by any of the documentation you're attaching. When it comes to dependents, right, they're not checking what you may have filed on your tax return. It's almost sort of an honor system when it comes to submitting that application. And they are giving you credit for however many child dependents you say that you have. But cost of living does not factor in there. So it's really a uh, sort of a, I would say, bare bones determination just using those top line numbers that are either self-reported and those then that are in the documentation you're attaching.
Okay, what if somebody's in default? What are their options?
Yep, and I'm going to talk about delinquency and default a bit more when we talk about or when we reach the policy section. But if you are in default, okay, you can't just enroll in an income-driven repayment plan. You first have to bring those loans back into what's called good standing. There are two options to do that. You can either consolidate the loans, consolidation being a free federal process by which you are basically combining or creating sort of a new what's called direct consolidation loan. This is sort of like a get out of jail free card because you can process that application in about 10 minutes. It takes about 30 to 60 days and it sort of brings your loans right back into good standing. Okay. However, if you've already consolidated, you can't do it again to get out of default. Okay. So that might be a factor there. The second way to bring your loans back into good standing if they're in default is through a process called rehabilitation. This is something that is negotiated with the debt collection agency through the Department of Education, where you commit to making 9 months of on-time payments. After that ninth payment, your loans go back into good standing, and then you have access to things like income-driven repayment. And getting out of default, through either one of those methods, and there are sort of some additional implications that go along with each one. So it's worth having a conversation. This is something that Savi helps many, many borrowers to navigate.
And then one last thing I'll ask. So IBR is only for federal student loans. It does not apply to private, correct?
Correct. Yes. Yeah. All I will just say this is sort of a note broadly. All of the programs that we're going to talk about here today are only applicable to federal student loans. Savi can help you with your private loans as well, but unfortunately, private loans are not eligible for any federal repayment or forgiveness programs.
And move forward. We'll get to the other questions later.
Okay. Thanks, Ellie. All right. So now we're going to talk about public service loan forgiveness or PSLF. So PSLF is essentially full forgiveness on the remainder of your loan balance, whatever that might be. It could be $5,000, it could be $500,000, all right? So it's the original principal amount plus any interest, okay, that's accumulated. The whole thing gets forgiven after you've made 120 qualifying payments. Now, what constitutes a qualifying payment comes down to satisfying these three things that you see on your screen right here simultaneously. So we'll start on the left-hand side with qualifying employer. You must work for a government organization at any level, federal, state, local, or tribal, or a non-for-profit 501(c)(3). The only stipulation here is you must work a minimum of 30 hours or more per week. However, you can combine multiple or part-time employment to qualify. So let's say you work part-time at one 501c3 and part-time at another 501c3. If combined you're working on average 30 hours or more a week, you can qualify for the program. So you don't just need to be full-time at one employer in order to qualify. A couple other things about the employment side of this. It is retroactive going back to October 2007. Why October 2007? That's when PSLF was actually signed into law. Okay. And I'll talk about this a little bit later on in the policy section, but that little detail makes it actually one of the strongest and most protected federal programs out there. There's a reason why it's been in existence since 2007. It would take an act of Congress to get rid of it or make any changes to it. Okay, so this program is not going anywhere. In fact, it has probably, like I said, the strongest protections behind it because of the fact that it is law. All right. Take that, right, and compare it to the SAVE plan, right? That was not put through Congress and passed into law. And that's why it faced so many sort of litigation challenges and was so easily sort of shot down in the courts. All right. So just to give some context there. But back to this October 2007, okay? Any employment that you've had that's qualifying from October 2007 to present day is fair game for the program. Okay. So in order to sort of satisfy the employment requirements, you don't need to stay at the same employer. Okay. In fact, most borrowers who achieve PSLF have on average 3 to 4 different employers that are qualifying over the course of their career that they are counting towards credits for the program. All right. But again, that sort of clock starts October 2007 to present day. Unfortunately, for the purposes of the program, anything prior to October 2007 is considered irrelevant. All right. So that's sort of when that clock starts. And if you're just finding out about this now, and let's say you've been working for, more than a decade, right, for a qualifying employer, beauty is, right, again, you can get that retroactive credit for those periods of time. So that's number one on the qualifying employment side. Number two, you have to have a qualifying federal loan or loans. Now, only federal loans, right, can qualify for this program, but more specifically, direct federal loans. Easiest way to tell if you have a direct loan is it will literally say the word direct or DL in that loan title, which stands for direct loan. To give some context here, the direct loan program, okay, is a federal loan program, began under the Obama administration around 2010. Okay, so it's sort of just it's a technicality and a name change. So if you had a loan dispersed to you from 2010 to now, there's a good chance it's a direct loan. If you have loans that were dispersed to you before 2010, they might be an older type of federal loan, what's called a FFEL loan, FFEL, which stands for Federal Family Education Loan. This was simply the name of the loan program prior to direct loans. Or if you have a Parent Plus loan. And maybe by a show of hands, if you're able to raise your hand on the webinar, I'm just curious if any of you out there have Parent Plus loans. These are loans taken out by a parent on behalf of a child, but in the parent's name. So these older FFEL loans and Parent Plus loans, okay? In order to become eligible for PSLF, they require a corrective action, if you will, and that is consolidation. You have to consolidate those loans into what's called a direct consolidation loan, at which point they can be eligible. Okay, so there's a pathway to eligibility there, but there's sort of that little hurdle that you'll need to jump over first. Okay, so that's on the qualifying loans. Last up here is you need to be repaying that loan on a qualifying repayment plan. And the only types of repayment plans that qualify are income-driven repayment plans. Doesn't matter which one you're on, it can be any one of those three, okay, as long as you are making that payment on time and for the full monthly amount. Now, you can also qualify some of your 10-year, let's say you were on the standard plan, those payments can also count. However, keep in mind, if you remained on the 10-year standard plan for the entire 10 years, that loan would be paid off, right? There'd be nothing left to forgive, which is why putting borrowers into income-driven repayment is part of the process around PSLF. All right. But if you had made some payments back and forth on that 10-year standard plan, those can count. Okay. So you basically need to satisfy all three of these requirements, okay, simultaneously. So you need to make 120 payments while working in public service, on your direct loans, and while enrolled in an income-driven repayment plan, or if you've made some payments on the standard plan, those can also count. After which, right, that entire remaining balance is forgiven, okay, no matter what that is. One thing I really want to clarify around PSLF is that it is not taxed at the federal level. Okay, so unlike IDR forgiveness that we just talked about, PSLF has always been and will continue to always be tax-free. All right, that's again part of the law. Now, I just want to clarify some common misconceptions about these 120 qualifying payments. First of all, they do not need to be made consecutively. You just need to make 120 total cumulative qualifying payments. So let's say you worked for a qualifying employer for 2 years, were making payments, and you accumulated 24 of these qualifying credits towards the 120 you need for PSLF. And then maybe you left to take a job in the private sector or you took some time off, right? Nothing happens to those credits. They simply pause. And if you were to ever resume your eligibility by resuming working for a qualifying employer, doesn't matter which one, it doesn't have to be the same one, it can be any qualifying employer, you can resume accumulating those credits towards 120. Okay. So again, does not have to be consecutive. You just need to get to 120 total. That said, you can only receive one qualifying payment credit per one payment per one calendar month, meaning you can't double up on payments in a month and get double the amount of credits, and you can't make a big lump sum payment and get more credits than you normally would. Easiest way to think about it is this. In any given calendar year of 12 months, the maximum amount of PSLF qualifying credits you can receive is 12, okay, one a month. So if you can only get 12 a year, right, and you've got to get to 120 total, you are all very smart and can do the math here. That's 10 years minimum before you'd be eligible to receive forgiveness on your loans. And that would be if you were making the payments and working consecutively that whole time, right? Which again, you don't have to. So many people describe PSLF as a 10-year program, but I discourage you from thinking about it like that because the determination of your eligibility and forgiveness does not come down to just your time served. It's coming down to these qualifying credits. I can't tell you how many borrowers I've worked with who have been public servants for decades, okay, thinking that they were eligible for the program, but they weren't making these qualifying payments. And so therefore they weren't progressing towards that finish line. So it really comes down to the 120, okay? And there's no way to qualify sooner than 10 years, if that makes sense. Now, how do you apply for public service loan forgiveness? Well, there is one form and one form only for this program, and it is called the Employment Certification Form, or ECF. This form gets signed off by you, the borrower, and then it needs to get signed off by your employer or employers. Any current or previous employers you may have had that you want to count towards the program, okay? So the employer, usually someone in HR with access to employment records, will basically attest to the fact that they are a qualifying employer, the dates of your employment, or if you're still working there, your average hours per week, and they will sign off. And that form gets submitted to the Department of Education directly, not your servicer. Your servicer handles the payment side of things. The Department of Education handles public service loan forgiveness. Now, after you have submitted these forms, all right, let's say the Department of Education comes back and says, Lindsay, you have 82 qualifying credits out of the 120 you need. Well, going forward, right, if I've certified all my past employment up to that date, going forward, it's recommended that every year at a minimum, you resubmit the employment certification form for just your current employer. Okay, you've already certified your past and gotten those credits. Now it's about maintaining, right, and bringing current the certification for your current employer. You submit that form so that way you can get credit for those past 12 months or so, and you can see that tally adding to your account on the Department of Education website as you inch your way closer and closer to that 120. Now, that's not a requirement that you submit it on a yearly basis, but it's highly encouraged. Why? Well, many borrowers who thought they were eligible for the program based just on, let's say, their time served and worked, or how many payments they thought they made, found out when they submitted these forms, thinking right at the very end, right? They submitted the forms for the first time after working for 10 plus years, that in fact they were nowhere near the 120 according to the Department of Education. So we encourage at Savi, and so does the Department of Education, that borrowers submit these forms early and often. So if you're in your first year of working for a qualifying employer, you can submit this form. It will activate a tracker on your studentaid.gov account towards PSLF. All right. And then going forward, right, you're going to want to maintain that certification as current as possible. I would say a year, sort of is a safe bet, right? Every 12 months, you want to get that certification and get those 12 credits counted. But more recently, we've seen borrowers doing this every couple of months as they get closer and closer to that 120. And oftentimes, the Department of Education reviews those forms a lot quicker if it only has to go back a few months or within the year, right? It could take only a couple of weeks compared to borrowers who wait to submit these forms until the very end. And the Department of Education has to go back over a decade. It has to pull payment history from various servicers that might have changed over the years. And I would say it only increases the processing and review time. So we're talking anywhere from 4 to 6 months. It also increases the likelihood that they make a mistake. I would say we see this about 50% of the time that errors are made in counting those qualifying credits accurately. So, all to say, early and often is sort of the mantra to go by when it comes to public service loan forgiveness. Now, I'm sure we have some questions on this. So, Ellie, if there are any that you want to throw my way, I'm happy to answer them now.
Yeah, there's quite a few. And I just want to apologize to everybody. My camera doesn't seem to be working, so you don't get to see my live face, and I'm sorry about that. Um, let's see. So this is kind of a long one. For PSLF, let's say I worked 10 years in nonprofits and my loans were deferred. I didn't make payments during those 10 years. Then I started to make payments, but I'm no longer working at a nonprofit. Can I still get them forgiven as long as I make 120 qualifying payments eventually, since I had a history of working in a nonprofit for the right amount of time?
Yep. No, it's a long one, but I totally understood it and great question. So, the payments you make have to coincide with periods of employment that you at a qualifying employer. So, if you worked 5 years ago at a qualifying employer, but you weren't making payments, that doesn't count, right? So those need to overlap and they need to be simultaneous, if that makes sense.
Okay, yeah, totally makes sense. I think generally the answer to the person's question is no.
Yeah. Yes.
Do you have any idea about how long it's taking to process the applications right now?
Honestly, it really depends on whether or not this is your first time submitting an employment certification form and how much sort of history they have to go back to. So if you've been keeping up with these and submitting every year and you're submitting one, that you did, maybe you submitted within the last year, you're submitting another one, I would say we're seeing review times less than a month. But if it is longer than that, or you're submitting multiple, we are seeing upwards of a month. And I would say in some extreme cases, closer to 3 or 4 months. It has gotten a bit better than at points in the past. But again, encourage folks to get those forms in early and frequently.
Are education institutions considered qualified?
So it depends on what type of education institution. Most higher education universities, colleges are actually 501(c)(3) nonprofits. If it is a government, like a public school, that would be considered a government entity. One of the great things about the Savi tool that I'll show you later on is we have a built-in database of every single qualifying public service loan forgiveness employer in the country. So if you are curious as to whether or not yours qualifies or any past employment qualifies, you can find out through the Savi tool when you enter in your employments. Because that's a pretty common thing. Most people are, not exactly sure, but we will give you the definitive answer.
And what if you're on an IDR plan with a zero monthly payment? Does that count?
I love this question because the answer is yes. In fact, that's like the ideal scenario. Every one of those $0 monthly payments counts as a credit towards public service loan forgiveness. And while we're sort of on talking about those $0 payments, I also want to note for all of you the COVID pandemic payment pause, all right, where payments and interest were paused for the majority of federal student loan borrowers, started March 2020, went through October 2023. My gosh, these dates, I'm getting old. It was about 43 months total, all right, during which you didn't have to make a payment. If you were working for a qualifying employer during that time, all of those months count as qualifying payments, even though you didn't have to make a payment. So, 43 out of the 120, that's putting you about a third of the way closer to full forgiveness without having to pay anything.
Okay, let's see. For the periods during the pandemic, I know there was a period where payments were suspended, but I believe they're still counted towards PSLF. Do we know what periods are counted automatically? And when a 501(c)(3) organization you work for goes bankrupt and you are unable to get an employment verification, what would be the best way to move forward to have that time counted? Sorry, it was two big questions, but it was the same person. I wanted to get them out
No
there.
worries, no worries. So the first part, I think I just answered. So all of those months during the COVID payment pause, if you were working for a qualifying employer, count. Now, how do you get them counted or added, right? It's not done automatically. You have to submit an employment certification form for employment that covered that period of time, all right? And that's when you would see that reflected on your sort of PSLF tracker on studentaid.gov. Um, as far as the second question, and this is actually quite common. If your employer is no longer able to sign off on the form for whatever reason, they close, they won't respond, etc., there's a process by which you are able to submit basically alternative documentation, a W-2, or a couple other options to basically, indicate that you were in fact employed during that time. The Department of Education will review and be able to certify the employment for you. So there are alternatives if you're not able to, if the organization no longer exists or you're not able to get that signature.
Okay, let's see. Somebody's asking if you're going to go over the buyback option.
You know what? I don't know if I have that in my policy updates, but I can talk briefly about this now. So PSLF buyback was something that was introduced within the last 2 years, essentially to allow borrowers who were pursuing public service loan forgiveness, and let's say had periods of time during which they were employed by a qualifying employer, but not making qualifying payments for one reason or another. And we're not going to count the sort of COVID payment pause as part of that. So maybe you had put yourself into a forbearance because you couldn't afford to make your payment. Or more specifically, and recently, maybe you were on the SAVE plan, okay, and you were automatically put into a forbearance when the injunction in the courts went through and they couldn't implement the plan, all right? So these are sort of periods of time, right, in which you were likely in a deferment or forbearance or maybe not making that payment. The PSLF buyback program essentially allows you to identify those periods of time and buy back those months to count as credits towards the 120 you need, okay? And you essentially buy back those months of payments at the sort of the rate that you would have paid on an income-driven repayment plan at that time. So they look at historical income documentation, or if they knew based on your enrollment. So let's say you were enrolled in an IDR, but you had gone into forbearance, based on what that payment amount was. All right. Now, we've seen this program was sort of introduced right around the time when most borrowers, sorry, I should say all borrowers who are on the SAVE plan were put into an automatic forbearance because the plan legally could not be implemented. And that forbearance started July of 2024, and it's still ongoing today. So borrowers who've remained in that SAVE plan have not had to make payments. That period of time, unlike the COVID payment pause, has not counted as credits towards PSLF. So the only means, if you are pursuing PSLF, to go about getting credit for those periods of time during the SAVE forbearance was to do the PSLF buyback. Okay. However, I will say this: the buyback request can only be made when you have 120 months minimum of qualifying employment. That's not the same as 120 qualifying payments. Otherwise, you'd get that forgiven. You'd be at the finish line. But it means you have 10 years or more certified within studentaid.gov and your PSLF tracker of qualifying employment. Okay. They won't even consider your request until you have that. All right. So if you think or know that you do, right, and you want to go about submitting a buyback, you're going to need to make sure all of your employment is certified in there before you can even submit that request. However, I will say this: the PSLF buyback process and system has been inundated for well over the last year of all the different federal programs operating right now with applications. It has the longest backlog that it continues to grow. In fact, the processing delay and wait time that we're seeing for borrowers who have requested a buyback is over a year long that they have waited to hear back. When you do hear back from about a buyback request, the Department of Ed will basically quote you a lump sum amount that you will have 90 days to pay, okay, in order to get the credit for those months. So this is something to keep in mind. Also, if you were on the SAVE forbearance, the payment amount that they're going to use, this just came out within the last couple of months, they can't legally use the payment amount you had on the SAVE plan, okay, to determine your buyback amount. You will be asked to submit income documentation and they will determine your buyback amount on another income-driven repayment plan, okay? Just as sort of a heads up to anyone who is pursuing this, because of that SAVE forbearance. So they will quote you that amount. You have 90 days to pay that back. But I would say the fact that the processing delays have only gotten worse over the last 6 to 12 months, and borrowers have been held up as a result, means this. If you are at the 120, right, qualifying, or I should say certified months of employment, okay, and you have, let's say, 4 months that you need, right, in order to get to 120 qualifying payments, you are going to reach the finish line much faster if you enroll in an IDR and make 4 months worth of payments than if you submit a PSLF buyback request and try to wait that out. You can obviously do that and maybe sort of, go into another plan and make those payments. But unfortunately, because of the interest in the program and because of how complicated it is to sort of review and make these calculations, it is the longest processing backlog of anything out there. And like I said, it's not getting any better. In fact, the results just came out from last month. It's only growing even more. So for those that are very anxious to get to the finish line and maybe only have a few months between that and 120, I would encourage you to look at your options in enrolling in another IDR plan so that you can start making payments because you will reach that finish line faster that way. I know no one likes to make additional payments, but you will have to pay an amount to buy back those months anyway. So just something to consider. I know that was a bit long-winded, but it was a great question. PSLF buyback is definitely an important program.
Okay, so there are a couple of questions that I want to welcome Dylan Clark. Dylan is here now and available to answer questions. There's a few questions that Dylan has answered in the Q&A, and I will ask Dylan not to do any more because I do want to get them in the recording. So I'm going to ask and read answers that Dylan put in. So if I have 50,000 forgiven, does that show as income in 1 year or is it stretched over a number of years? It depends on the type of forgiveness. PSLF, not taxed at all, so that 50,000 does not count as income. IDR forgiveness, like ICR and IBR, typically taxed as income. The full 50,000 would be counted in 1 year, not spread out. Are there separate applications for the different IDRs, or does the servicer just determine which one to offer you? This is one IDR app. There is one IDR application. When you submit it, you can either select a specific plan, IBR, pay, etc., or choose the option that says something like, place me on the lowest monthly payment plan. And then I think there's one more. Yes. Since the current administration wants to dismantle the Department of Ed, where would certification go? The short answer is that nothing changes right now. PSLF certifications, ECFs, still go through federal student aid via studentaid.gov, and your servicer, typically MOHELA, processes them. Even if there are policy changes, the functions don't disappear. They'd be moved to another federal agency or contractor, and there would be a clear transition process. And I think, oh, there's one more. If a parent works for a public university and have a Parent Plus loan, can they qualify for loan forgiveness? The answer is yes. If the parent works for a public university, they can qualify for PSLF. For Parent Plus loans, they must consolidate first to become eligible. And there we go. There are still some open questions, but we can move on.
All right, great. Thank you, Dylan, for answering those. So now we are going to transition and talk about some of the more recent and major student loan policy updates. And again, these are sort of as of today, April 30th. I say that because things are changing so rapidly these days that it's important to note and want to make sure that's noted for the recording. So first up, let's talk about the SAVE plan. So the SAVE plan forbearance that borrowers have been in since July of 2024 is coming to an end. The plan was officially terminated. And in the last month or so, the Department of Education has issued guidance around how they will be actually ending that plan and moving those borrowers currently in that SAVE forbearance into other plans. So just want to run through some of the facts around the situation right now. So currently there are about 7.5 million folks still in SAVE and on that forbearance. There were close to about 9 million total who had enrolled in SAVE when it first came out. So what the Department of Education has sort of announced is that starting July 1 of this year, servicers will issue a formal 90-day notice to borrowers to select a new repayment plan. Okay. If borrowers don't act within that 90-day window, okay, they will be auto-enrolled into the standard plan or the new tiered standard plan, which is one of the new plans coming about July 1. And for most, if not all, folks who are on the SAVE plan, the standard plan is going to be exponentially higher. Okay, that's because nearly half of people who are enrolled in SAVE actually qualified for a $0 payment, and that the way that the plan was calculated compared to the other income-driven plans made it the most affordable. Like I said, it basically cut payments in half. So that means, payment amounts could jump to hundreds, if not thousands of dollars for borrowers who do not act within that 90-day window and enroll in an alternate plan. So based on sort of the timing of this, right, July 1, 90 days, this means the SAVE plan forbearance is going to end by September 30th of this year. Okay, so September 30th is sort of that drop dead date as far as, when action needs to happen by. All remaining borrowers who are still on that SAVE forbearance, who have not selected a new repayment plan and switched out, will be auto-enrolled starting October 1. Okay. All right, so that's just sort of important context here. Now, what should borrowers do, all right, who are still in this SAVE forbearance? So for those who are familiar and who have access to Savi already, one of the benefits of the tool and resources is the fact that it's designed to show you the best repayment options, save notwithstanding, and then help submit an application for that new plan automatically. So this is something you could do through your Savi account, and I'll show you how to set that up a little bit later on. As a reminder, like we talked about earlier in the presentation, there are currently 3 IDR plans available to enroll: IBR, Pay, and ICR. Starting July 1, there will be a 4th, which is called the WRAP plan, and we'll talk about that in just a second. This is sort of the Trump administration's new flavor on IDR. It's called the Repayment Assistance Plan. If you are pursuing public service loan forgiveness, I encourage you not to wait, right? As a reminder, these months in SAVE forbearance don't count as qualifying credits, okay? And so it's in your interest to move out of the SAVE plan forbearance sooner rather than later if you are able to find an alternative payment, on another IDR and start getting those credits each month a payment is made. As a heads up, the servicer backlogs are very much real. Nothing compared to the PSLF buyback backlog. That is by far and away the worst of them all. But as of last month, when the Department of Education published its application data, there are currently about 500,000 IDR applications still in the queue waiting to be reviewed by servicers. Okay, so the implication here being you want to apply early, right? That you don't want to sort of wait until the last minute to move out because there's a very strong chance that the servicer will take a month, if not more, to review that, and you will have already been auto-enrolled into the standard plan. Now, if you do happen to get auto-enrolled into that standard plan, you can submit an application to go into an IDR after that, all right? But we're trying to avoid a scenario in which you are auto-enrolled back into standard. One of the reasons being any interest that has accumulated on your loans, okay, when you go into the standard like that, that interest capitalizes, which means it's tacked right onto your principal balance. It's what's called a capitalization event. So we want to try to transition borrowers in SAVE forbearance into another plan before that capitalization event can take place. All right. So that's what's currently happening with the SAVE plan. I saw a question come through, Ellie. I'm just going to answer this one out loud if that's okay. On this SAVE, someone asked, after 9:30, could they still request to change to IBR if they realized their stupidity and cost of payments? Yes, as I just said, you can still submit that application and switch into the plan. All right, next up, let's talk about Parent Plus loan borrowers. And again, as a reminder, Parent Plus loans are loans taken out by a parent on behalf of a child, but in the parent's name. Okay. And in fact, this is actually the fastest growing demographic of student loan borrowers. It's parents ages 50 plus. Okay. Many people think about student loans, they think about young people, right? When actually that's not necessarily the case. These Parent Plus loans have become more and more popular. However, they are soon to face and are in the process of facing some big changes this year that are going to make it harder to access repayment and forgiveness options. And sort of the timing of all this matters more than ever. So here's what's happening. Under the One Big Beautiful Bill Act, Parent Plus loans that are not consolidated by July 1 of this year will permanently lose access to all income-driven repayment plans and forgiveness programs. Okay. Now, when we say consolidated by July 1, we don't mean submit the application for consolidation by July 1. We mean that loan must be complete, that consolidation must be completed, and that loan must be a new direct consolidation loan by July 1. Now, because the sort of the consolidation processing timing takes about 4 to 6 weeks on the good end, I would say probably 60 plus days when we start to see sort of an increase in volume. All right. Because of that, we have been encouraging, and so has the Department of Education, that Parent Plus borrowers submit those consolidation applications by April 1st, so the beginning of this month. Okay, and it's now April 30th. Okay. Now, if you were to consolidate today, all right, you could risk that that consolidation does not complete by July 1. And if it does not complete, then unfortunately you are out of luck. Okay. So the practical deadline that we've been sort of really trying to communicate to everyone is April 1st, as sort of the point at which you'd want to have that consolidation submitted by to be safe. If you submitted it today, all right, so we've got pretty much 60 days exactly, give or take, right? There's a good chance it could still go through in time, but we can't make any promises around that, and there are no guarantees. However, if you do miss the July 1 cutoff, okay, so your loan is not consolidated by that date, you lose access to all income-driven repayment. You will only be able to pay that loan on the standard plan, which means you will not have any pathway to forgiveness, whether IDR or PSLF. Okay. Also, one thing I want to note, what I'm calling sort of the new loan trap, if you take out a new Parent Plus loan after July 1, all right, you forfeit income-driven repayment access for all of your Parent Plus loans, even the ones, let's say you consolidated already. So if you completed your consolidation by July 1, thinking, okay, great, I'm in good shape, but you take out a Parent Plus loan after July 1, you forfeit access across the board. So here's the sort of headline. The April 1st deadline has obviously passed. You can still submit a consolidation application, but it will be processed at your own risk, and it might not be completed before the July 1 cutoff. Okay, so, and again, sort of the sort of consequences, right, are that you are going to lose access to income-driven repayment, and for many folks, that means lower payments and forgiveness options. So this is a big one for anyone working with someone who might have Parent Plus loans or who has Parent Plus loans. I would say please reach out to us here at Savi, and again, we'll show you how to do that at the end if we can be of assistance, given sort of the very important deadline and timing around this. All right, next I want to talk about delinquency and default, and really the crisis that we're seeing happening right now. Never before, in the history of federal student loans, have we seen a default rate this high. Currently, and it's probably a little bit higher at this point, closer to 10 million, 10 million plus borrowers are in default on their student loans. This is the largest number on record in history, period. It's about 1 in 5 borrowers. Okay. Now, just to give context here, going into default, or when your loans go into that status, it means you have missed 9 months of consecutive payments. Okay. That's what triggers default. Now, before default is delinquency. Okay. And that happens at 3 consecutive months of missed payments. Well, 25% of all federal student loan borrowers are now delinquent, okay, which is triple the pre-pandemic rate. So 1 in 4 borrowers are delinquent. They've missed 3 consecutive monthly payments on their student loans. And the consequences that we're seeing as a result of this are tremendous. I would say, most importantly, because it's impacting other areas of someone's financial life, most importantly, their credit score. So we are seeing on average about a 57-point credit score drop for borrowers who hit delinquency. Okay. And obviously, many of you know the implications around this, right? You're locked out of housing and credit, loan opportunities, things like that, right? That's just from delinquency. And I would say 57 is probably on the low end. We have seen instances where borrowers overnight have had their credit scores drop by 150 to 200 points, which is akin to a personal bankruptcy filing. All right. So this is having devastating consequences on millions and millions of borrowers' financial lives. Every 9 seconds, a borrower is going into default on their federal student loans. Okay. So I say this because there are serious consequences that I'll talk about in just a second here when it comes to delinquency and default. Outside of just reporting to the credit bureaus, right, and seeing that score tank overnight. But when you reach default, you lose out on a lot of other opportunities to receive any type of federal loan outside of student loans as well. You're not able to receive additional aid. And in many cases, you are subject to what are called involuntary collections. And I'll talk about that in just a second. So what do you do, okay, if you know you're in default, but for most folks, they're not really sure, right? It's not like the Department of Education says, hey, Lindsay, you're now delinquent, or now you're 7 months, right? Many borrowers will just see that their account is falling behind or past due, and they'll see that sort of past due amount continue to grow and think, I'm not able to pay this off, right? How can I ever bring my loans back into good standing? This is saying I'm $6,000 past due, right? And it just goes from there, right? That's sort of a slippery slope. If you are behind, or if you're not exactly sure where you stand, please, 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 I encourage you to use Savi as your lifeline in this moment. The rehabilitation or consolidation options are something that we can explore to get those loans back into good standing. But more immediately, we can help sort of stop the bleeding. On a past due amount, okay, let's say you're checking your Mohila account and you see it's past due $6,000, and you're thinking, there's no way I can pay that. How am I going to ever bring it to good standing? Something that most borrowers don't know, you don't have to pay that amount to get your loans back into good standing. There are two ways to do that. One, you can request a forbearance. All right, so you can call your servicer and say, I'd like to request a forbearance to bring my account current. They will use forbearance and wipe out the past due amount. Now that gets added onto your principal balance, right? But it brings your account from past due to current within a few minutes. Okay, so that's one option. The second is when you submit an income-driven repayment application, once that's processed, the account is automatically brought current without having to pay a past due amount. Okay. So there are ways in which to bring the account current, and that's probably the most important and immediate step anyone wants to take if they are past due, because many folks aren't exactly sure how many months or, what, where they are in sort of the delinquency to default sort of timeline. All right. So it's important that if you know that you're in default, but really, if you're not sure where things stand, that's kind of I would say, the biggest demographic here, right, for most folks. This is the time to figure it out, find out, and to make sure that your account is current before you experience some of the devastating consequences, like a huge hit to your credit score that can be damaging for the rest of your financial life. Now, when it comes to consequences for default, I had just mentioned something called involuntary collections. So when you have federal student loans and you fall behind and you go into default, it's not like a private loan or a credit card where, it will continue to hurt your credit, but eventually, right, they'll sort of stop coming after you and that debt will get sort of sold off. It'll remain on your credit report for 7 years, right? But otherwise, there aren't any consequences. That's not the case for federal student loans. They will come after them until they are paid, and they have a couple different methods and means of doing that, including wage garnishment and tax refund seizure. Now, before I talk about what those are, I want to say this. They were supposed to begin in January for borrowers in default. The Department of Education shortly thereafter announced that they are putting a temporary pause on those collections activities. But this pause is not a forgiveness. The collections are expected to resume later this year. And so borrowers should treat this as a window, or this window of time as an opportunity to act, not a reason to wait. Okay, it's almost like we got a bit of good luck here with a few months in which they haven't yet initiated those collections activities, in which borrowers can turn things around before those start up. So, what is wage garnishment and tax refund seizure? Well, wage garnishment is when the Department of Education contacts your employer and legally requires them to basically garnish 15% of every single paycheck. Okay. This is something that your employer is forced to process. All right. And I will tell you this, it is one of the most punitive, sort of most impactful things I've ever seen borrowers have to experience prior to COVID, because garnishment was on pause throughout the entirety of COVID, and for a couple of years after. When we worked with borrowers who were experiencing wage garnishment, I will tell you honestly, most of them ended up having to quit or leave their jobs because they could not afford to remain employed and be getting garnished. They had to go find a job where they were earning cash outside the system. It is sort of a really, really damaging thing for anyone to experience. And unfortunately, once it goes into effect, sort of once the wheels are in motion, it's very difficult to stop. You have to request a hearing with a judge in order to present your case as to why the garnishment should not go through. And then it will require a 9-month rehabilitation of your loans, during which that entire time your wages are getting garnished. Okay. So again, that's currently paused, but it will resume later this year. All right. And one thing I can say from all my experience in working with borrowers, it is the one thing you want to avoid at all costs. You are susceptible to it if your loans are in default. So if you know your loans are in default, now is the time to get them out of default. Okay. When it comes to tax refund seizure, this is basically the federal government or the Department of Education seizing any tax refund that you might get. So it doesn't even hit your bank account, it goes right to the Department of Education. Okay. Again, that is currently paused, but expected to resume later this year. So remember, you still have available both loan rehabilitation and consolidation as a means to get defaulted loans back into good standing. In fact, one of the positive things coming out of the OBBBA, oh my gosh, a mouthful, is that it actually gives borrowers a second chance to rehabilitate a defaulted loan. Up till now, if you had gone through loan rehabilitation and then defaulted again, you couldn't do loan rehabilitation again. All right. Now they're going to allow borrowers to go through loan rehabilitation a second time. All right. But again, the window to act is now, because once collections resume, your options are going to narrow significantly. So encouraging folks to reach out to us and utilize Savi as the resource and benefit it was designed to be, to really be a lifeline right now. Again, especially because we are seeing delinquency skyrocket across the board. And with the SAVE plan ending and 7.5 million people being forced from no payment for 2+ years back into hundreds and thousands of dollars worth of payments, we expect that those rates are going to rise even further. In fact, it's estimated that the default rate could hit upwards of 15 million by the end of the year. So we really want to try to intervene now if we can. All right, hold on. I'm just going to take a quick sip of water here. Okay, moving on to the new repayment system that we're going to see coming out in July 1 of this year. So I had mentioned earlier on, right, that sort of under different presidential administrations will typically see sort of their own take or flavor on income-driven repayment. Under Biden, it was the SAVE plan, which is no longer. Under the Trump administration, it is the Repayment Assistance Plan, or RAP. So this is going to be the newest income-driven repayment plan. Okay, scheduled to launch July 1 of this year. However, we're not just sort of adding this one into the mix. This plan is designed to ultimately replace several of the existing income-driven repayment plans. And I'll explain how this is going to sort of work. But first, let me give a sort of a high-level overview of how the RAP plan is structured and how it will calculate monthly payments. So under RAP, it's going to look at a sliding scale of 1 to 10% of your adjusted gross income, okay, depending upon what that is. All right. There will be no more $0 monthly payment. Okay, that won't be an option. Every monthly payment minimum will be $10 a month. So even if you are unemployed or have no income, you will not qualify for a $0 monthly payment. It will be at least $10 a month. Okay. Now, there are some interest protections provided under the WRAP plan, similar to those that were provided under SAVE. So, unpaid interest is canceled monthly if you make your payment. Again, this is designed to prevent balances from ballooning because of that interest. You're also eligible to receive a $50 a month principal decrease contribution towards that goes directly to the principal balance on your loans. When it comes to IDR forgiveness, the timeline has been extended under WRAP. So under the other plans, right, it's 20 to 25 years. Under the WRAP plan, it's 30 years. However, WRAP is PSLF eligible, okay, which means you could receive forgiveness at 10 years with qualifying employment. Now, Parent Plus loans, the bad news just keeps on coming, unfortunately. New Parent Plus loans after July 1 are not eligible for WRAP or any other income-driven repayment plan, okay? Which means they will be forced to pay back on standard plans only. So when it comes to existing borrowers, right, folks that have loans right now, okay, going to this sort of July 1 date, they can remain on their current IDR plans through July of 2028. So if you're on pay, IBR, ICR, you can continue to remain on that plan through July of 2028. However, after that, they are sunsetting the pay plan and the ICR plan. Okay. So after which, or at that point, you will be forced to choose between WRAP or IBR. IBR is the only of the sort of old standing income driven repayment plans that will continue to exist. Why? Why? Because it was signed into law, like PSLF. Again, so that's why you see sort of the continuity and longevity of those federal programs that were signed into law. So after July 2028, the only two income driven repayment plans that will exist are WRAP or IBR. Anyone who takes out loans after July 1 of this year will only have access to WRAP. That's it. The only plan available. Okay. So it's only current borrowers, right, that are going to have access to WRAP or IBR and are able to stay on their current plans. But the system going forward will be sort of solidified down into one plan. Okay. Now, while this seems like a step in the direction of simplification, right? Okay, let's just have one type of income-driven repayment plan. Based on how WRAP calculates payments compared to the other plans, it may not be a more affordable option for many, if not most folks. Okay. And so while it might look like simplification sort of on the outset, really what it's going to do is limit affordable options for many, many folks and force those monthly payments a lot higher in many instances. So one of the things that Savi, again, was really designed to help borrowers do was, based on their information, evaluate what those IDR repayment options look like at this point and in the future. And that's exactly what sort of our tool can help you see and then make that decision going forward. All right, another big topic to cover here. An announcement that was made in the last month or so is that the 1.7 trillion federal student loan portfolio, okay, is moving to the Treasury Department from the Department of Education. On March 19th, Department of Ed announced an interagency agreement to basically transfer operational management of the federal student loan portfolio over to Treasury. Okay. Now, this is going to happen in phases. All right. So I'll sort of outline these out right here. Phase one is that Treasury is going to take over collections of the about 9 to 10 million defaulted loans using their private collection agencies. Okay, so defaulted loans are the first ones that are going to sort of move over to Treasury. All right. Phase two is that Treasury is going to assume operations for all non-defaulted loans, so all the rest of the federal student loan portfolio and servicing for all borrowers. Now, it is very unclear what this is going to mean for borrowers as far as sort of day-to-day administration of their loans, what will happen to their existing servicers, how that will function and operate, etc. So we are waiting to hear more details and guidance from Treasury and Ed in the coming weeks and months. And then phase three is Treasury will assume responsibility for FAFSA, Pell Grants, and any remaining federal student aid operations. Okay. Now, to be clear, when we talk about transferring operational management, okay, we're not talking about the policy. So the policy, right, that drives programs like public service loan forgiveness and those rules and qualifications and eligibility, right, all of those that will remain with the Department of Education. Okay, it is sort of the administrative and operational management, the collection on the debt and things like that, that is transferring to Treasury. But really, what this means is nothing changes for you today. Okay, especially if you are not in default, nothing changes. Your servicer, repayment plan, payment amount, forgiveness progress are all unchanged. You should continue making payments as normal. Um, what you should do is that you have access to your servicer account as always, right? You want to make sure you know who your servicer is. You can access that account online and that your account is current, okay? Keeping records of your payments, right? These are things that we have encouraged borrowers to do, especially over the last couple of years, given a lot of the shifts and changes. Always good to make sure that you are downloading statements and keeping a record of that for your own protection. And then keeping an eye on your inbox for any updates from the Department of Education or your servicer around the sort of the movement of the loans and how that might impact you. But if you are in default, okay, especially, again, now is the time to act. You really want to try to bring that loan or initiate that rehabilitation or consolidation before Treasury's operations on collections are fully in place. Many experts estimate that in this phase one, once those defaulted loans are moved over, that's pretty much the timing around which we'll see the resumption of involuntary collections because they'll be utilizing their private collections agencies. And the exact time frame right around when that phase one will be complete is a complete unknown right now. So again, makes every sort of hour and day more precious for anyone in default to get out of default as soon as possible.
And when does that phase one start?
So it has technically started, but there has been no concrete sort of date or dates, I should say, as far as specific actions and things like that. So they've basically described it that they're initiating for this sort of phase one, but we don't know exactly when that will be complete and what that will look like. So because of that, I think it's made it even more anxiety ridden, right, for folks who are in default. But I would say this, once it's complete, and it may happen that we hear about it next week that it's complete, right? It could sort of be sometime very, very abrupt. It makes it even more important to try to initiate a rehabilitation or consolidation on a defaulted loan as soon as you possibly can. All right. Last big topic that I wanted to talk about today is on public service loan forgiveness and a new employer eligibility rule that is also coming into effect July 1. July 1 is sort of the date of the hour, but really the big date for this year as far as when a lot of things are going to affect and changing when it comes to student loans. So what's happening with this new employer eligibility rule? So before I go further, just as a reminder, right, and I've said this a couple of times already, PSLF remains one of the strongest consumer protections in the entire federal student loan system because of the fact that it was written into law. It was actually signed into law under the Bush administration. But it's this environment around PSLF that has been shifting, and even more reason why borrowers need to stay vigilant and on top of those employment certification forms. So what's changing is starting July 1, the Department of Education can now deny PSLF credit for employers who they deem to have substantial illegal purpose. The language targets organizations who deal with immigration, gender affirming care, DEI, and nonviolent protests. So basically, the Secretary of Education can say, this employer, let's say the County of Los Angeles, we deem to have a substantial legal purpose and therefore will no longer be eligible for public service loan forgiveness. Now, what that would mean is because they are deeming the employer not eligible, all of the employees, starting at that point in time, July 1 after, by working for that employer, would no longer be able to receive qualifying credit for that employer. It was as if it was never eligible. Okay. Any employment up to that point, all right, during which it was a qualifying employer, will still count. But it's only after, if an employer is named ineligible, that future employment won't count. Now, the Department of Ed itself estimates that fewer than 10 employers per year will be affected. Okay. So 99.5% of all public servants, nothing's going to change, right? If they're going to name only 10 employers, just to give you a sense, we estimate there are close to probably 3 million eligible employers in the country. However, they have not released any names or indication of specific employers that are under review or being targeted. There has been nothing explicitly published or released around what employers may be impacted starting July 1. Okay. What this means for you. Uh, First of all, the core PSLF requirements remain the same and unchanged. 120 qualifying payments. You need to be full-time or 30 hours or more per week on that eligible repayment plan. Okay. Same thing, government organizations, federal, state, local, tribal, and 501c3 nonprofits remain qualifying employers. If your employer was disqualified, all right, the payments you already made would still count. Only the employer, okay, not the employee, can appeal a disqualification. All right, so borrowers cannot appeal directly if their employer is affected. Now, I will say this. There are currently two lawsuits in effect. One brought by AFT, the Teachers Union and Protect Borrowers and Advocacy Organization, against the Department of Education. And then there is another lawsuit from, I think, about 20 plus state attorney generals against the Department of Education around this eligibility rule, deeming it a substantial overreach and application of the Secretary of Education's authority. And really, the law is in the favor of these organizations suing because it is very clear that by the law of PSLF, all right, if you are a government organization, if you are a 501c3, you qualify. There's no gray area. That's it. And so they are currently in the process of litigation right now. We may hear updates in the coming weeks. And I would not be surprised if there was some type of injunction that went through that held this ruling up. Most across the board see it as an egregious sort of overreach and politicization of the secretary's powers. However, if that doesn't take place, July 1 is when this will go into effect. Again, we have not heard any specific names or any more information on how they plan to sort of enact this and what the process would be around appealing a disqualification. But what you all can do as borrowers and for those that you might be working with, continue certifying your employment. And in fact, you want to make sure now more than ever that your certification is as current as possible. Even if you submitted it 4 or 5 months ago, I'd encourage you to submit it again. All right. Make sure that is current and you've got the credits up to at least, the present day. All right, so just to sort of recap here on the key dates and some of the sort of the changes that we talked about over the last half hour or so. So April 1, again, already passed, but this was sort of the practical deadline for Parent Plus loan consolidation, right, to preserve their access to income-driven repayment. July 1, this is the big one, right? We've got the Save formal 90-day servicer notices beginning. We've got the WRAP plan and the tiered standard plan launching. The PSLF employer eligibility rules take effect, and Parent Plus loans, will lose IDR access if they are not consolidated. There are also several other federal student loan changes on the sort of borrowing side when it comes to new loan limits as far as how much you can take out that are also going into effect on July 1. But for the purposes of this presentation, wanted to focus on sort of the changes that are impacting sort of current borrowers as we speak. Now, from July through September, servicers are going to be contacting borrowers in waves, the borrowers in that say forbearance. September 30th, that forbearance effectively ends, okay, for those earliest notified borrowers. And starting October 1, borrowers who haven't switched out of Save are going to be auto placed into the standard plan. And then if we fast forward a bit, right, June 30th of 2028, right before that July 1, 2028, pay and ICR repayment plans will sunset for good under the One Big Beautiful Bill Act. So I know that this is a lot, right? And it can seem overwhelming and daunting. And I will say this, it's changing constantly, and no one should have to keep up with all of this information on their own. And the great news about today and our tool and resource that we're providing to the NHRC community is that you don't have to. And so one thing that I want everyone to sort of walk away from all of this is that not only does the team at NHRC have your back when it comes to student loans, but the reason why we work with NHRC and they work with us, right, is because they recognize that Savi can be a powerful advocate and value for so many folks, and we're always in your corner. So a couple just different things I want to highlight when it comes to sort of the changing policy landscape. With a Savi account, we are sort of the responsible messengers when it comes to any and all important policy updates and information that might be happening that could impact you. So we deliver those developments right to your inbox. We've got sort of policy and breaking news alerts. We've got what we call our State of Student Debt newsletter that goes out the first of each month. We host town halls and webinars on a weekly basis. Actually, our next town hall is next Wednesday that I host. It's the first Wednesday of every month, and it focuses on the latest in policy and updates. So every change, we will make sure that you are informed and prepared every step of the way. When it comes to your Savi account, which I'm going to show you in just a second here, your Savi dashboard, when you log in, right, you're able to review your personalized repayment options, see where those applications stand, make sure you've submitted all those forms, and track any upcoming deadlines around recertification and things like that. So all of that in one centralized place. We've also got our incredible Help Center, which has step-by-step guides on things like consolidation, rehabilitation, switching into another plan, the PSLF employment certification. If you want to know anything and everything around PSLF buyback, we've got an incredible Help Center article all about it and can guide you through submitting that request as well. And then last but not least, our Savi support experts. This is access to one-on-one personalized support from our team of student loan specialists, which Dylan helps lead. Dylan has been at Savi almost as long as I have and works every day one-on-one with borrowers in a variety of capacities to help them navigate these complexities and have those tough conversations and really help them get to the finish line. So again, just to reiterate, regardless of the change, we are here with you and with the NHRC community through everything. So with that, before I kind of transition to the next section, I will take a quick pause and pulse check. And Ellie, if there are any questions, I'm happy to answer out loud.
Well, I just want to say that I can feel the sensation of freaking out from everybody who has a student loan that they are getting their time
Yeah,
at their nonprofit. We do, I mean, housing counseling agencies are with intermediaries that have been specifically targeted by the administration. So I'm sure that some people are freaking out a little. And I do appreciate that you said there's probably going to be some lawsuits around all of this. So I do think that everybody can be a little less freaked out about it. You see, Sheila Hawthorne said we're exhausted. Yes.
yeah.
So anyway, thank you for saying that. There are a couple other questions that are related to IBR and um, wondering about forbearance stuff. Do you want me to go ahead with those, or do you
Sure.
would?
Yeah. Maybe we'll
Okay.
take a, I know that that was a lot of information down there, so we'll take a quick sort of pause so everyone can catch their breath, and I'm happy to answer those.
Yeah, okay. For IBR forgiveness, what if you have some loans borrowed before 2014 and some borrowed after 2014? Would some loans be forgiven in 20 years and some could be forgiven after 25 years?
So the way that the system works, if you have loans before 2014, you're on the old system, even if you have loans taken out after 2014. So you would be on the 25-year path, regardless of with all those loans. Um, just that's how they do it. If it's like if you take out if you have any loans before the date, even if you have loans after the date, you still got the loans before the date, and therefore you're on sort of the longer timeline.
Okay. I am working with someone who has had payments deferred since COVID. She reports it was done automatically. She has been on IBR Save and is unsure how to proceed. Any first step suggestions?
Yeah. So this is, I would say, honestly, a very common scenario because of the fact that, we basically went from, starting March 2020, right? That pause. If there was sort of a year of kind of an on-ramp period where payments were technically due, but none of the consequences like credit reporting or delinquency default were sort of enforced. So it kind of was almost like an extension of that. Okay. And then we had the save plan. And so if they were enrolled in the save plan, maybe qualified for a $0 payment. And then I would say a few months after the sort of the save plan really got rolled out is when the injunction went in place and everyone was forced into forbearance in 2024. So I would say I see the scenario quite a bit where folks just have been sort of put into the automatic non-payment as a result of either COVID or save. And what needs to happen now is a transition into a new repayment plan. Like that's for anyone in that scenario, but that's the long and short of it. So I would encourage this borrower, and if you're helping them, and you can do so through Savi, as I'm about to show you, to look into their options on the other income-driven repayment plans, and to try to get enrolled in one of those if the payment amount is going to be affordable for them to start and resume making those payments. So the sort of headline is sort of a switching or exiting save and entering into another income-driven repayment option.
And one final question, I'm sure more will get typed in as you're talking about the next section, but I have pre-purchase clients, those wanting to buy a home that are on forbearance through 2028 on their student loans. What advice should we be telling them?
Well, if they are on forbearance through 2028, this could be for a couple different reasons, but I suspect maybe it is because they've gone back to school, or they are in sort of what's called an in-school deferment status, meaning if you have existing student loans, and you go back to school, you basically you don't have to make payments on those loans while you're pursuing your additional education. That's one of the reasons why that sort of first comes to mind as to why they'd be on a forbearance through 2028. They also could have put themselves into a forbearance. You can do so only up to 12 months at a time, however, but you are allotted 36 cumulative months of forbearance to use over the course of your loan. So it either might be a scenario of, again, they're not, those loans are sort of in a deferment status where they're not technically in repayment yet, or it was that they put themselves into a forbearance, although I don't suspect that it would last till 2028. I would say this, the um, sort of whichever sort of reason behind that is going to matter because it's going to inform the steps that you'd want to take to potentially bring them out of that sort of forbearance or deferment and into repayment. And so there are kind of a couple different options. But by doing so, it also would then trigger a monthly payment to be due. So this is a bit of a complicated one, but something that we see all the time here at Savi, and happy to help have that conversation and navigate. But it will come down to some of the specifics around this person's situation.
And one more quick one. Does taking out additional student loans restart the clock on PSLF?
It does not. So you can kind of think of PSLF and sort of your loans as different horses in the race, if you will. And so if you have loans, from 2015, right, and you've been working for a qualifying employer, and now you take out a loan this year, you will have more qualifying credits, right, on the loans from 2015, and likely be closer to that 120 than you will on the loan you took out, this year. So when that loan goes into, when any loan goes into repayment, right, and you're working for a qualifying employer, that's when the clock starts. So it's very common, and we see this across the board, for borrowers to have different qualifying credit counts for different loans, especially if they've taken them out at different points over the years.
That's it.
All right.
Onward.
All right. Well, I know that the feeling of being exhausted is a common one. Especially, I find when it comes to student loans, it's one of those where, many folks who don't have them, they're lucky. But it's really hard to understand, sort of the world in which someone with student loans lives, right? I mean, just think about the different topics that we've covered here today. I often think, if this was going on in, let's say, the credit card industry, right, there would be massive uproar, right, across the country. It really leaves borrowers at a huge disadvantage, and we recognize that here at Savi. And so, while these programs can be helpful in theory, right, you're faced with so many different options that are constantly changing, right? We just explained IDR, income driven repayment, but at the same time, and in sort of a second breath, we said, yeah, but those plans are going to be sunsetting in 2028, right? This is sort of the reality for student loan borrowers. But when it comes to what's the best path forward, right? What's the best plan for me? What do I need to do now? The whole goal of Savi is to make that clear. All right. So as I'm about to show you, a few screenshots from the accounting experience, just to kind of give you a look and feel. But we're going to ask you some basic questions to collect some information. And from there, we're going to show you a personalized repayment and forgiveness plan if you're eligible, right? Down to the cent as to what that would look like, and all the different options, so that you can really see for the first time in one place, okay, based on where I am right now, this is what the path forward could look like. We also monitor for new programs and policy changes. This is what I personally oversee here at Savi, to make sure that all of the information, resources, estimates, etc., that you are seeing within your Savi account are the most accurate and up to date. Okay. If there, as soon as there was the change on save, right, within minutes, our tool was updated. And it's hugely valuable because borrowers need to know that the information they're seeing is the right one, right? I will say you can compare that to the Department of Education itself. For many, many years during COVID and even after that, the Department of Education website remained out of date. It would show you old information, or show you an inaccurate payment count or dates and things like that, which is incredibly not only unhelpful, but detrimental to being able to figure out where exactly things stand, right? And add on top of that, it's nearly impossible to get a hold of your servicer if the wait times are 2-3+ hours long. And I know from personal experience, it feels like every time you call, you're getting a different answer, right? And so again, this is where within Savi, we've tried to create an environment in which you can trust the information and the data and the numbers that you're seeing, and the people behind it, right? But then we take it a step further because I think it's great to show people their options, right? But we know that there's sort of a big gap between, okay, seeing what that could look like and then taking those steps, submitting those forms and applications, gathering that right paperwork, and actually getting enrolled and then tracking towards that finish line. And so that's where Savi provides sort of a premium level of services where we take on all of that administrative burden for you. We pre-fill, digitize, and submit all the paperwork from income-driven repayment applications to public service loan forgiveness employment certification forms. We actually, start to finish, get those signed off by your employers for you and submit them to the Department of Ed, right? All of that we've built into our tool to eliminate human error, and to make them more efficient and to ensure that borrowers are actually able to reach that desired outcome. And the best part about those sort of premium levels of service is that borrowers get access to one-on-one support at any point in time via a number of different methods: telephone, email, live chat, message through their account, you name it. And they have usually a sort of dedicated expert that they're working with on our team throughout the entirety of that experience, right? So you're not having to re-explain what's going on with your scenario, right? There's a continuity that allows you to feel like you are in good hands, and you are. And the best part is that we've used technology to try to simplify all this, right? So instead of having to submit 4 or 5 different applications on your own, one for my income-driven repayment plan, okay, and then I've got 4 employers that I've got to get certified and all those. With Savi, we've taken a different approach. You have one application, what we call our Savi application, right, where we're collecting this information, we're showing you those options, and then from there, we're pre-filling the various applications needed. Okay, you don't even necessarily need to know exactly, which plan, right? You're like, this is the lowest one. Okay, we're pre-filling those and submitting those to your servicers and the Department of Education on your behalf. And then we're monitoring them with you to ensure they achieve the desired outcome. If we've submitted an application to Mohila for you, right, and it's been over 2 months since you've heard from Mohila, we are going to help hold Mohila accountable and follow up to see and inquire on the status of that application and make sure it's getting processed, right? These are a lot of the things that borrowers experience: submitting an application, not hearing back, it getting rejected, they're not sure why, right? This eliminates all of that. So just to give you kind of a look and feel of what the Savi experience is like, when you log into your Savi account, you reach the dashboard. And you kind of think of this like mission control for everything Savi. It's where we are going to show you all the things that might be going on, the status of your applications, prompting you to take those next steps, right? You can see here someone's being prompted to start a new employment certification form, right? With a click of a button, they can do that. So for folks who are wanting to submit those employment certification forms more frequently, right? Literally as easy as a click of a button. And for those that have multiple employers, maybe you've had a tough time tracking someone down in HR from a place you worked 10 plus years ago, we do that for you. Okay. So we take that burden off of you. Now, when you're ready to get started with sort of that Savi application, right, where you need to collect some information, we're going to ask you some basic questions. You can almost think of it like a TurboTax for your student loans, right? We're kind of collecting this information here. So you'll see this is sort of the family section. We're asking you your tax filing status, dependents, right? We're going to ask about your income. As we learn, these are important factors in determining your income-driven repayment plan options. We're also going to ask about your employment, right? And as we talked about, this is important in determining your forgiveness eligibility. We have a database built into the tool of every public service loan forgiveness employer, as well as teacher loan forgiveness. This is one specific to in-classroom educators we didn't touch on today, but that is built in, as well as 150 plus state level forgiveness programs as well. So when you start typing in your employer name, if it's eligible, it should pop up in sort of that drop-down menu. We'll ask you some clarifying questions around, your dates of employment, things like that. I encourage you to enter not only your current employment, but any previous employment you might have had. Because remember, these programs are retroactive. So the more complete employment history you're able to enter, the more complete estimate we're able to give you as to exactly how far along towards that forgiveness finish line you are. And then the last step is linking your student loans, both federal and or private if you have them. We give you a couple different options to do this. You can use our really easy loan sync, which pulls from publicly available credit bureau data by entering your phone number and your date of birth. You can upload your student loan data file, or otherwise known as your NSLDS file, which you can download from the Department of Education website. This is sort of like the official record of all your loans and payments. Or you can enter the information in manually. So we give you a couple different ways to do that. But at the end of the day, it's very important that we understand exactly what loan types you have, right? If it's an older FFEL or Parent Plus, what that disbursement date, interest rate, balance, etc., all of that looks like. And then that's it. From there, we are able to show you what your plan options look like. And this is just an example of someone who we've identified the pay plan as their best option. So they can see what their new monthly payment amount would be, that total payment over time, so how much they would have paid in total by the time they either pay off the loan or they achieve forgiveness, how long until that loan would be paid off or forgiven, and how much in forgiveness they'd be eligible to receive. They can expand below for more details. They'll see a comparison of that plan to the standard plan amount. And they can also see their options on other, income-driven plans that they might be eligible for as well. But we usually identify at the top the one that we think is the best. Now, from here, the next steps are going to be submitting all these forms and applications, right? And that's where we give borrowers the choice. So you can create your Savi account, enter all that information, see your best options, all for free under what we call our DIY account. And if you select DIY, we will basically send you the applications with instructions on how to complete and submit them, and you can do so on your own. But if you want to enlist Savi's help in taking on that administrative burden for you and really ensure that you are going to achieve the desired outcome and get any help along the way, you can upgrade to Essential or Pro. These are sort of our premium plans where you can go a bit further, right? So that's where we're going to create your applications digitally, help submit them to your servicer to make the process as simple and efficient as possible. I'll just give you an example here. Public service loan forgiveness, up until about a few years ago, had a 99% rejection rate. Now, that has dropped down to about 96, 95%, I would say, rejection rate, okay? Not great, right? Most of the rejections around public service loan forgiveness, right, those employment certification forms, are because of manual or clerical errors. The date format is filled out incorrectly. A line is left blank, right? And so the application will get rejected, and borrowers oftentimes think, I must not be eligible, when in fact it is just an administrative or clerical error on that form that is keeping them from moving forward. So the way that we've set this all up is to remove all of that human error. It's literally impossible to submit the form with any type of information missing or error through the Savi process. And so in fact, we have a 99% acceptance rate on our employment certification forms and all applications across the board. To date, we've found about $5 billion in forgiveness for borrowers across the country through our various partners and communities. So really, I would say our bread and butter for anyone trying to pursue public service loan forgiveness, this is really where we excel. But we don't just submit it and stop there, right? We monitor those loans and applications with you, okay, to ensure you're on track. So, recertification deadlines for your income-driven repayment plan. We're reaching out to you 2 months before that deadline to start having the conversation around what the upcoming year could look like, any changes or fluctuations in your income or family size. We make sure that application gets submitted well in advance, right? When it comes to your employment certification forms, right? A reminder, hey, it's time to submit that again, right? And I would say best of all, for most student loan borrowers, especially coming from sort of no trusted source or guidance at all, is the access to the one-on-one personalized support from student loan experts. And I'll talk about that more in just a second. I just wanted to give you sort of a deeper look into kind of the essential or premium accounts. So on the left-hand side here, you can see this is someone with 3 different public service employers, okay, that they need to complete an employment certification form for. Simply with the click of a button, they can click Start ECF. We are going to collect some additional information, all right, on that employment, and then we are going to pre-fill that form. The borrower is able to sign off from their Savi account, and then we send it off to those employers to acquire the signatures for you, okay? As many previous employers as you may have. And we monitor those. So, for example, if the application has gone unsigned for a certain period of time, we're following up with that employer and finding an additional contact if necessary. And this is just a quick example of sort of this pre-filled digitized experience on the income-driven repayment application. Now, when it comes to monitoring those various applications, right? So the same person, right from their Savi dashboard, can monitor those 3 employment certification forms. They'll see the exact status of what's going on, right? So awaiting HR signature. Your PSLF form has been sent to your employer HR contact and is awaiting signature. As soon as that form is signed, it will automatically be submitted to the Department of Education, right? And that status will update. Okay, so you can see here, this is a different status, right? It's been successfully signed and certified, and your PSLF form has been submitted. Oops, sorry, guys. And then this is also someone with an income-driven repayment plan, right? So they are being prompted to attach that supporting documentation. So all of the things that you need to get these applications done and done correctly are going to be monitored and managed right from that one place. So many borrowers submit an income-driven repayment application without attaching income documentation. What that does is usually it will sit for about a month in the processing queue before it then gets rejected by the servicer, and the borrower is then prompted to add that information, okay? And maybe they're not sure how to. They've got their long tax return. Do I fax this? How do I upload it, right? It's really not an easy self-service path. But what it results in is borrowers not effectively getting into the plan, okay? And that's what we're here to solve. You can see here on the right, it's just sort of a zoomed in look at how we track the different statuses around certain applications. So a borrower is able to see exactly where they stand at any point in time. And from my perspective, it provides a level of transparency and visibility that does not exist anywhere else, right? Even on your own servicer account, right? Where it's difficult to find information, you're not sure what you're looking at, or the Department of Education website. We are trying to sort of break through that. And then last but not least is Savi's customer support, which can be accessed right through that Savi account. So you can click contact customer support, send a message to our team. You can live chat. This is not AI. These are our actual experts, Dylan and her team, who are on throughout the day and able to have quick conversations. We also have a telephone number as well that you can access through your Savi account and our help center. So, couple of next steps here. I know we are running a couple minutes over. Apologies, Ellie and team. But just a few sort of points of clarification. NHRC members receive a significant discount on the price, the yearly price of an essential plan. And you can reach out to Ebony for details on what that looks like, and especially if you're not a member, on how to become a member. And non-members, all right, would not receive sort of that discount. So, that premium level plan is subsidized for the NHRC member community. And we appreciate their support. So you can learn more by reaching out to Ebony as to how to access Savi if you should desire. But we hope that you can all access and utilize that tool and reach out to us if you need help or assistance. I hope that this has been helpful and informative and not too much of a buzzkill, but I'll turn it over to Ellie and team in case there are other questions that I can help answer.
So there's just one last question. When is filing a bankruptcy a solution?
Ooh, uh, I would say this because oftentimes student loans, well, it's been tricky. We've seen a couple instances where they are discharged in bankruptcy, but oftentimes not. They are not. So I would say I am not an expert enough around bankruptcy to be able to sort of make that determination or give you guidance there. You may want to discuss that with a lawyer because I know that there are a lot of other implications involved just outside of student loans. But I will say that as far as doing that or pursuing that as a fix to your student loan situation, may not result in that, desired outcome, if you will. But I would consult a bankruptcy lawyer for more details and information.
Great. Thanks so much, Lindsay. And with that, I think we just are going to wrap it up. We're over by a few minutes. Thanks, everybody, for sticking around. And there will be the recording on our YouTube channel after Ebony works her magic to make everything look pretty. And thanks again to Dylan and to Lindsay for your time and energy today and answering all the questions.
Thank you
And
for having us. And thanks for everyone for reaching out. And if there's other sort of information, Ellie, or questions that come up, Ellie and Ebony usually sort of forward those on to me. So I'm happy to answer them offline. But thanks, Dylan, for joining me. And thank you for having me
Thank
once again,
you.
guys.